I want to share the principles and the thinking that have helped me as a new investor to garnish a 20% or up unrealized return. Now, I'm not a pro investor, but here I'll show you some of the results that I've gotten so far for the last month and a half after starting this. So this is my first account. It's inside of Cash App. As you can see here, that's the day, week, month, 35% for the month, 32% increase for the year. And these are all the stocks that I've picked. If you look at them, they're all positive because I'm using these principles to pick these stocks. So they're all positive so far. Now we can go over to, I'll open up Robinhood, which is where I have my Roth IRA. And some of the stocks I picked in here are a little bit more conservative because I plan on keeping them for 20 years no matter what. But as you can see here, over the last month, it's still a 13% increase in value over the last 3 months since I've started it. And so pretty cool. There's some results to show you real quick before I just start sharing my philosophy that I'm using, that I've learned and that I'm using because I didn't make this stuff up. And so here's what I'm doing. It's the opposite of what I used to do when I would try stock investing because I've tried this before, right? I used to try to follow the old adage of buy low and sell high. Right? Everybody knows like buy low and sell high. But at the same time, things happen in the market and we see the stock price for something shooting up like Nvidia over the last couple of years. And then we feel like we missed out, right? We're like, oh, like we don't feel like we missed out like it's past tense. We feel like we're missing out, like we're still currently missing out. And so then we want to like just jump in the boat with everybody else because everyone's all excited about this thing. And I've done this so many times with different stocks at different times in my life. And then I jump in the boat. I buy the stock after everyone's already talking about it, after it's already had this huge gain. And then it starts going down and down and down. And then I get scared and I sell. And then I just like locked in my losses and I lost money. And so that is the opposite of what I've been doing over the last month and a half. So here's what I've been doing. I've been looking at companies that I feel like are undervalued. Here's the thing, like if you talk about Nvidia in 2023 when the stock price like hit its all-time high or whatever year that was, I'm not sure off the top of my head, but talk about Nvidia when the stock price is hitting its all-time high. Well, when it's hitting its all-time high, most likely it's overpriced because people are all hyped up, and this is because of supply and demand. A lot of people want to buy it, so the price goes up, and then people buy it, and then the price goes up, and then people buy it, and the price goes up. It has nothing to do with the economics of the business anymore. And so that's what I mean by overpriced. You have to compare the price of the stock to the economics of the business itself, not comparing it to what you think the price is going to be later because more people want it. Like, forget all of that and look at just the economics of the actual business. And this is the one way that I like to look at it. And Warren Buffett helped me out with this one. So shout out Warren, the OG. And that's whenever I'm buying a stock, I look at like, okay, if I had the opportunity to buy this entire company, like if I had the opportunity to buy the entire company and own the whole thing, would I want to do it? And if the answer to that question is I don't know, I don't have enough information, well, that means I need to do more research. I need to look at their financial statements. I need to look at, okay, what was their gross profit over the last couple of years? What was their net profit? How much were they taking home over the last few years? Okay, what's the market cap? Because when you look at the market cap, that's the price of the business. And it's like, okay, is the market cap more than 10 times the amount of net profit that it's making? Like, if it's like, if the market cap, if the whole price of, let's say that there's a business, to break this down like really fundamentally and like simply, let's say that I look outside and there's a hardware store in the corner. And I talk to the owner and I say, hey, how much would you be willing to sell this hardware store for? And he says, "Oh, dude, I'll sell you this hardware store for $100,000. You can have it, $100,000." And I say, "Okay, cool. Well, how much net profit are you actually making running this hardware store per month? I mean, what's the net profit just per year?" And if he says, "Well, after expenses, insurance, salaries and wages, taxes, after everything, uh, we make about $1,000 net profit per year." Well, that hardware store is overpriced. I should not be paying 100 grand for that thing. Pay 100 grand so that I can make 1,000 per year. Like it's gonna take 100 years just to get my money back, right? And so when you look at the mechanics of an actual business, that's when you can see if the stock is overpriced. And the market's crazy because the market will actually have things that are priced out like that. It'll be like, hey, the market cap, that's the price of the business. The market cap, if you don't know, that's the amount of shares that are outstanding times the share price. So that's what the market capitalization is. And so if the market cap is like 100 or 1,000 times the amount of net profit that the business makes every year, well, how is that a good deal? Unless you could look at their books and see that they're spending a lot of money to buy assets like what Amazon did. Amazon spent a lot of money and borrowed a lot of money for 20 years and they weren't making any profit, so that they could build and own assets to create their own distribution system to make a lot of profit later. Well, that would be a different story. But even when you do invest in companies that are doing that, it's still, there's a lot more risk there because you don't know if everything's going to go right over the next 20 years. And that's why it's like, well, if you do invest in companies that do that, they pay big when they work out and they pay nothing when they don't. And so I've been investing mainly like 95% of my funds in companies that make sense economically. And when they make sense economically, it's like I can see how the business is going to grow for the next 20 years. And it makes sense to me from looking at their financial statements, um, looking at their income statement, looking at their balance sheet, looking at their statement of cash flows. And you can find all this stuff on Google Finance. It's free. You just type in the ticker and then click on financials. You can pull all this information up and look at it yourself for like the last 5 years. Look at all their stuff. And then I look at, well, what's the price of the stock? And just like how the market will have the stock because people will be excited, so supply and demand will make the stock go up when it doesn't really need to go up. Well, the market does the same thing. Trump will make here's an example. Trump will make an announcement on tariffs, and then all these investors will get scared. They'll feel fear, and they'll say, "There's no way that this company is going to be able to manage these headwinds and this and that." So they'll start selling their shares so that they can go buy bonds. And then because they sold shares, the price of stocks will go down. And you're like, okay. And so in this example, this is like that hardware store that's making $1,000 per year in net profit, right? If I went up to that hardware store owner and I said, "Hey, I want to buy your business. I think I looked at the financials. I know that you're making $1,000 per year net profit. How much will you sell it for?" And if that hardware store owner said, "I'll sell it to you for $1,000, deal, like right away. Cool. Here's $1,000. I know I make my money back in a year, and then every year after that, I'm just making profit." And that's if the business stays the same. That's if we don't even improve it. If everything just stays the same. I just made $1,000 per year every year after that, just keeping everything the same. Of course, we want to try to improve it and to grow. But if he said something less than that, it's like sometimes the market will be crazy, and he'll be like, "Give me $500, or give me $75," and and this is when stocks have gone way down because there's everybody is fearful about things, and you can see that, well, the business looks sound and it looks fine from looking at the financial statements year over year, and then actually understanding the economics of that business and understanding the constraints of that business and the bottlenecks, also understanding what it's selling to the customers, how it's making its revenue, understanding its mission statement, and then looking at why people are afraid, and then seeing where these things don't match up. And those are the things that you want to buy. And the cool thing about knowing this is, like, right now the stocks are up today, right? Like, all the stocks that I like, that I think are really sound companies that I've looked into and that I've investigated like this, they're all up today. So I see that and I go, well, I'm not buying anything. I'm not buying anything, not today. Um, and that's because they're all overpriced right now. I mean, it's really cool. It makes my portfolio look good. It's like, wow, look, the percentages are all up. This is how much I would make if I sold these things today. But I bought these things to hold on to for the next 10, 20 years, especially like in my IRA. That's like 20, 30 years. And so I'm not selling them. And I'm just looking to keep buying things when the market goes crazy and decides to put them on a discount. And then I buy it. And I just keep doing that. And so I guess the moral of the story is, do your research. Like, that's what I've been doing. And treat it like you're actually buying the business, because you are.